Welcome back. Welcome back. That intro is probably a little louder than I think I want it to be. So if it is, let me know. I'll lower it. I'm playing with a bunch of different intros and trying to figure stuff out. Well, guess what? Rates went up 0.75. Powell just moved it up. What does that mean? Well, the whole idea is we have this massive inflation. Everybody's paying $6 a gallon for gas. Lumber's crazy high. Well, actually, lumber's kind of coming down, but food is stupid expensive. You're paying twice as much, if not more, for almost everything except for milk. For some reason, that's still subsidized. So probably a little bit more, but chicken's like $15 when it used to cost $5. Beef is crazy expensive. Vegetables are crazy expensive. And that's all part and parcel to us paying for the trillions of dollars that we printed in the United States. Problem is that it's the same thing globally. Talk China, Canada, New Zealand, Europe, all over. Russia's kind of doing their own thing. Cost of energy in Europe is going rampant because of what's going on in Ukraine and all that. And that's what it is. Inflation is crazy, and our dollar is still strong. Why is it still strong? Because globally, all the other countries are having a hard time. That's just kind of part and parcel what's going on. But the stock market's doing well. Yeah, the stock market's okay, kind of going up and down. It hasn't really made a decision yet. That's because we're not officially in a recession, but financially, when you look at the numbers, we're in a recession. It's just part of the thing. So today I'm going to add you in real quick. Hang on. Today we're talking about rates and all that other stuff. We have a whole bunch of other stuff to talk about. Hang on, let me get you in here. All right, so that's our show, blah, blah, blah. Housekeeping, we already talked about the reunion. Reminder, we have a podcast. If you don't watch this live or you don't want to watch the video and you're driving home during traffic time, traffic's getting pretty bad these days, turn off the radio and turn on the podcast. It's right there. Silicon Valley Living. Really convenient for you. It's an iPod. It's in Google Play. It's in Anchor. It's Silicon Valley Living everywhere. So there you go. Again, last month was Mental Health Awareness Month. Tell your friends, reach out to your friends. If they've been quiet, you don't know what they're doing, just reach out to your friends. It's going to be a crazy time in the next couple of years. Tell everybody about 988. I don't know how effective that is or what have you. It is what it is. This show has been brought to you by Video Ease. And a lot of what I do, you see my channel, I do a lot of video logs and walk through videos of my listings, etc. It's all done post-production by Video Ease. If you're a small business owner or another realtor, consider using Video Ease. It's a commercial. Again, we're doing community help. We're doing some community outreach. I do Bikes for Kids. I do the park cleanup. We adopted the park. I just got voluntold to help out with beautifulday.org. And it's a local community place that goes out and helps out. If you're interested in doing some stuff, hanging out, helping the community, meeting some new friends, let us know. It's beautifulday.org. All right. Come back here real quick. Tomorrow, I have the beautiful and talented Callie Vincelette. I used to call her Castaneda, and I couldn't get that out of my head. That's how long I've known this lady. She's amazing. She's a wealth of knowledge. You have to stop by and watch. Just got to talk. We'll talk about all things real estate and where the market's going from a 500-foot view. She does escrow and title, so she sees a less myopic view of what's going on in our community, not just Silicon Valley, but also the entire Bay Area. And we'll talk more about that. Headlines, look at all that. Lots of stuff happening. Tons of stuff happening. Mostly the rates. Moody's Zandy said that we're in for a deep freeze. All this stuff, everybody's saying it's going to happen in the next 2 to 3 years. I already see it happening. I see it kind of slowing down. I don't think it's crashing. I don't think the market's going crazy crash. I think what we're seeing is the market's just kind of taking a breather. A lot of buyers are sitting on the fence thinking, what should I do? What should I do? So there's less buyers. You don't get the 17 offers anymore, 20 offers, 100 offers. You're not seeing $100,000 over listing price. And I'm going to go into that in a little bit. We'll talk that when we go into the numbers part. Lacker was a former Fed president. I believe that was him. He went through and talked about why we need to be at least at 6, rip the Band-Aid off, stop that inflation, get cost of money back to normal. The problem we're having right now isn't just real estate. It's the cost of money for everything, for business, for commodities, for consumer, for automotive. And we went through that last week, or maybe Monday. The cost of money needs to be normalized. It's been too cheap for too long, and that's created this massive inflation, which is not helping anybody but the government because they collect more taxes that way. Wages haven't sprung up. Wages haven't equalized to this inflation, so we need to lower the inflation. Home builder sentiment falls. You can't really see it. Let me see if I can change this real quick. Right next to here, right here. Home builder sentiment falls, and we've been talking about that for a long time. There's no more news. Well, there's not no more. Home builders are slowing down on housing starts. Even if they have a 450 unit building and they're halfway through, they're going to stop that because there's absolutely no reason for them to continue to build and give discounts and incentives and all these other things to continue to do it when there's less margin. Right? That's why you're going to see it. And I think we talked about it a couple of days ago. Let me go over here real quick. There's a little map here. These are all the home builders in different areas and the numbers of units that they're putting out. So this is going to pull us out of the flattening out. Sorry. Let me get this real quick. The fact that our population continues to boom, continue to grow, our population will continue to grow. We need to continue to build homes. Where is this? There it is. Maybe I should just back out of that real quick so I can get to where I want to go. There it is. This little chart right here. Building is not completing and continuing to meet the demands of our population growth. And it is worldwide. This is US. This is over the last, 50, 60 years. And this is what's going to pull us back out. But for the time being, we need to stop worrying about housing and start worrying about our economy. Home builders are not going to sell a product and not make a profit. Investors are not going to invest their money into home builders that cannot turn a profit. So they're just not going to do that. And I've been saying this for months. The next indicator is unemployment. Labor will there's going to be massive layoffs coming. I don't know how I can get that copy link. I think that was a YouTube. If you want anything here, if you want to see what I'm talking about, I have all these linked. So I have resources, I have sources that I can talk about, but I'm just kind of going through everything. We already talked about the lenders going bankrupt. This is getting worse and worse. 2 companies over $800 million in bankruptcy. That's not good. And it's just the first to fall. Foreclosures are up. It's not as newsworthy as you think yet. These are pre-foreclosures. You're like, well, what's the difference between a pre-foreclosure and a foreclosure? It's simple. There's a notice of default. You own a house with a mortgage on it and you stop paying on it After 30 days, they issue a notice of default. That's a pre-foreclosure. They have to go through an entire process of going through the legal system, making sure that all the dots and T's and the T's are crossed and I's are dotted, and that the contracts are correct before they move to the next process of foreclosing on your property. There's a whole lot more layers of fat in between to protect the consumer, because what happened in 2008, it wasn't massive. There was a small percentage of people that had their houses foreclosed on them without due process. So now we're understanding that it's going to take 9 to 12 months to do an entire foreclosure. So what that's going to do is that there's going to build up a shadow inventory of these NODs, notice of defaults. These are people that are unemployed. They're sitting in their house, not paying, making mortgage, living for free. The bank is taking this into arrears, and this shadow inventory, which happened in 2008, will continue to build. It's just going to hurt the market a whole lot longer for a whole lot longer. But anyway, they say that it's up, and they're saying, oh my God, it's up 2,300%. Well, if you looked at the numbers, let me see if I can come to it real quick. There's a little graph here. There you go. So this graph is really telling when you think about it, right? And Atom is the parent company of like a big data company that we use all across the nation. This is 2008, 2009 right here, right? 2008, 2009, 2010, 2011, we start coming out of it. These are foreclosure starts, right? These are notice of defaults. They stop making payments. They issue a notice of default. All this stuff happens. These are starts. But from this number here in 2020, I want to say that's 2020, Q3 2020, which is the lowest part in the last recent history. From this point to this part, this is what they're doing to build the news. And what they're saying is it's up 2,300% or something crazy like that. That's salacious. That's crazy. It's not. These numbers are just there. Though that headline is there to make you click on it. So don't panic on that. Okay. Our foreclosure is going to be a major part of our inventory in the next 2-3 years. Yes. Is it going to be as crazy as it was in 2008, 2009? I don't have a crystal ball. Nobody knows, right? Absolutely nobody knows. I know one indicator I can tell you is if you look at Airbnb and the fact that they're oversupplied, and they're becoming little pricks to their hosts. And we talked about that on Monday. Again, we're going, when you look globally, you're seeing, I talked to my cousin who lives in Canada. He's thinking about moving to Victoria. And, we're talking about all this stuff. He's like, well, should I buy now? I'm like, I can't answer that. I can tell you that your mortgage world is kind of hurting. They don't have a standard 30-year mortgage. They have a 25-year mortgage. They have typically what people buy there in Canada are, from my understanding, I'm not an expert, and if you're Canadian and you're listening in, please let me know. I'd love to bend your ear on this show. They typically get 5, 3, 4, and 7-year loans, and then they flip them. They refinance after that because the cost of living on a interest only 5 years is much less than a fully amortized 25-year loan. So just makes financial sense to them. However, now that their cost of money is going up, there's going to be a lot of forced sellers. So the assumption is if this continues to happen, not foreclosures, but they're forced to sell because they're like, I don't want to refinance and double my payment right now. I just don't. So I'm going to sell my house. I'm going to lose my equity, I understand, but I just don't want to spend $10,000 Canadian dollars, which is really like 75 cents. I'm just kidding. It just makes sense, right? China's going through the same problem, like 30%, 40% of the housing right there in China, I understand, don't have any sources on that, are starting to go on foreclosure. Same thing in Australia and New Zealand. Same thing I don't know about Europe, but Europe is having an energy crisis right now, right? So what does all that mean? It's just something to keep an eye out for you. Just, that's why you should tune into this every day or every week. Listen to what I'm talking about. If you have ideas or you think I'm wrong, guys, I'm not 100% perfect. I'm never going to be 100% right. This is just me reading the tea leaves. I don't know what's out there. I have no idea. I want you to tell me this is right or this is wrong. Here's some other information. Let's talk about this, right? Why am I doing these videos? I am looking at different areas to invest in. And while I have some money to invest in, I need other resources to help buy property and hold cash to buy and develop and refinance or refurbish homes in different areas. We're looking and doing area spot checks on different areas right now. We haven't really found a target market for us to find in right now. Once we do that, we will have relationships with property managers, contractors, agents, etc. Because that's just what we do. I want to build a network of investors, people that have a source of money that want to invest in it, so that we can grow our empire together. I do have blood in this game. Every deal that we do, we're going to have blood in the game. So it's not like this will be like a lone wolf type of thing. You will be working with me, and we're going to do it the legal way through, a REIT or an syndicate. I'm not sure exactly how that's going to build out. We're going to have lawyers and accountants taking care of all that stuff. If you want to be an investor, there is going to be a minimum buy-in. We don't know what that is. If you're interested, let me know. The bonus here is you can become a passive investor. You don't have to deal with anything. We're trying to figure out what that makes everybody, what kind of money that's going to make everybody. So if you're an agent, listen closely on this. If you watch this and you're an agent in a different area, I don't need you if you're in Santa Clara County, right? I just don't. But if you're in Miami, and let's talk. If you're in different areas and different areas that are going to be hurting, let me know, right? And the reason why is because this is what we're doing right now. We're looking at all of these numbers at different different cities, and we're trying to decide which area is the right area for us to invest in. It might be 2 or 3 different areas. We don't know. All right. So here are the numbers one by one. Oh, I didn't look at REOs. Let's look at that real quick. 20. What was it last week? 22. So there's less REOs. Okay, so the difference between that number and the headline, the pre-foreclosures, and the actual numbers that are out there, these are homes that are actually taken back by the banks and put on market. So it's not thousands, not yet. I'm just keeping that as an indicator. All these numbers here pretty much are single family homes, less than $2 million. I know it's not every house in San Jose, so it's a very targeted market. Again, less than $2 million, 3+ bedroom, multiple counties, and over 40 days for this number. Same thing with here, 90 days. So the numbers continue to increase. And remember when I started doing this a few months ago, these numbers were 25 and 30. There's a whole lot more houses that are sitting on market a lot longer. It's not that we're still seeing houses sell. We're still seeing multi-million-dollar houses sell. We're seeing houses that are completely turnkey and beautiful and priced right sell. But we're also seeing houses that are missing the mark, whether it's pricing, location, or condition, that are just not selling. Or the sellers are getting offers and they're just holding them. And that's okay too. We're going to go down into this in a little bit. Pretty informative information. 90-day plus, that inventory is growing as well. Again, this isn't anything to panic about. This is just stuff to be informed about so that you know it. And if you're an agent in another area, let me know. I'm going to have you send in information. And once every couple of weeks, I'll have you jump on and give us a report on what you're seeing in your area. It'll be great for your business. Today was the rate hike. We got that 0.75 basis points, or 0.75%. I don't want to go into that. We have less homes for sale in my target range than last week. And that's good news. But my assumption is two things. One, people are like, forget it, I'm done selling. I'm just going to wait for the market to come back. I don't need to move, right? Those were the wishful buyers or sellers. And the buyers said, you know what, I better hurry up and buy something this week before the rates go up. And that's exactly what happened. So we had, I don't know, 5-6 less than last week. So that's a good positive thing. Vito, why are these cells orange? The numbers that you're seeing in the media, the numbers that are being reported, the numbers that everybody's saying everything's great, everything's rosy, everything's going great. We're still seeing prices increase. The numbers that they're reporting are 30 days behind. Let that sink in again. Let me repeat that. The numbers that they're reporting are 30 days behind. So let's take a little bit of a walk down history lane for 2 months, right? Everything here in June is what happened. All these numbers here happened back in May. And that's like, hey, why is my house still worth 20%, 30% more? Well, that's because that was the market back in May. Well, rates went up June 15th. We had a 0.75 rate hike June 15th. And today we have another 0.75 rate hike June 15th. These numbers right here are reporting from 30 days ago, from June 22nd to June 29. We do 7-day increments because it's a week, right? So yeah, the high was 117%. The low was 77%. The average sales price was 1.486, which was still more than the week before. Week from June 15th to June 22nd reported 1.428 million. And these are the medians, right? So I'm just letting you see these kind of two different levels. Days on market shrank this week. That's huge. That's a great indicator. But again, my feeling is because there was some anticipation of this rate hike. So days on market went down, which is, again, good. Is this going to continue to go? I don't know. I have a feeling that this right here is going to be a major thorn in a lot of buyers' sides. I saw somewhere, and I read it, from that rate hike in June 15th, it displaced, that's a bad name, that's a bad word. It put out 18 million home buyers. It made it less affordable for those home buyers to buy at their target range, and they just exited the market, which is why we're seeing the slowdown. Is it torrential? No, I don't think so. I think it's just kind of right now we're just seeing like the tremors happen, right? Pendings went down. This is a new number for you. These are houses that were actively listed last week, or the last few days, from the last 7 days, that went into contract. So what I should do is get a number of all the listings that are in contract. But these are the houses that went into contract in the last 7 days. Closes last week were 50. I'm like, well, is that good or bad? Well, 2 months ago it was 90, 100, 80, right? In that price, in that range. So we're definitely seeing velocity of closing slow down. Even here, right? From 68 to 70 before the rate hike happened to about 50 now. I think this is going to be a huge index for us to watch. Cancellations are homes that were listed last week and are no longer listed. They were canceled, expired, or withdrawn. They either went to 90 days or 6 months and they expired, or the sellers are like, I don't need to sell right now. I'm not in a hurry. I'm not hurting. I don't need to sell. Let's just take it off the market. This number is going to continue to grow, I think, as this number continues to grow. TFTs. And I don't know how or why this word came around. TFTs are transaction fell through. So they went into contract and they got back out of contract. The buyer pulled out. They could qualify. They found something wrong with the property, right? Whatever the story is, they got out of contract. They put the house back on market. I think this number is going to continue to grow too as these numbers continue to decrease or lower. List price decrease. Huge jump this week. This is not an aggregate number. This is last week. 33, almost a third of the houses listed right now have seen a price decrease. So there you go. Pricing is coming down. I don't think it's crashing. I absolutely don't think it's crashing. I think there's still buyers out there, but I do think, let me get back over here. I do think we have a lot of buyers sitting on the fence. I don't know how bad this downturn is going to be. It could be horrible. And I think that's why we're seeing less volume, less velocity in sales. But if you've not seen this graph before, it's very telling. I'm going to jump into here real quick so you can see a little bit more. When the market goes up, there's more competition. You have investors, you have multiple buyers. Everybody gets into the FOMO, fear of missing out. I need to buy a house. I need to buy a house. I need to buy a house. So competition increases price, right? At the top of the market, at the peak of the market, everybody kind of sits on the sidelines, tries to figure out where the market's going. Is it going to continue to go up, continue to go down? You're going to have less competition. Hey, Mr. Buyer hasn't bought a house yet, but you've been in the market for the last 2 years. You remember the last 2 years, how many offers did you write? 15, 16, 17. You got frustrated. You're like, I'm out. Peace out. I'm going to come back later, right? I'm going to wait until the market crashes. That's great. You absolutely should. But understand right now, everybody has that same sentiment. There's people on the fence that are sitting there. There's buyers still. There are still buyers that are like, I don't care. I'm still going to buy. I don't care if I buy today or tomorrow. It doesn't really matter. I'm going to buy. I have less competition. I don't have 15 other offers I have to compete against. I don't have to worry about putting $200,000, $300,000, $400,000 over list price. Just not going to happen because I'm going to come in at asking price or maybe a little bit less. That's what I'm seeing. It's what we're seeing all across the the whole Bay Area. I don't know what's going on in the rest of the U.S. As the market crashes or as the market increases, competition comes back into the market. Hey, this is a great time to buy. Maybe I should buy. The more competition further down, it becomes a crazy, crazy market. And then all of a sudden you're in a trough. You don't know how to time the trough. You don't know how to time the bottom part. Hey, what should I buy now? Well, I don't know. I can't tell the future. Nobody can tell the future. Here you go. Are we at the bottom? I don't know. You don't know. Nobody can ever time it. So when's the best time? When's the best time for you to buy? At the peak and at the bottom. Right now, people that are buying, they're probably thinking, I can buy 2 or 3 houses. I'll buy here, and I'll buy here, and then I'll buy here, right? So as you go down, there's more competition that comes in. And as you go up, there's more competition that comes in. So going back to my little story, get out of this real quick. Yeah, buyers are in the driver's seat for sure. I haven't really put together a cohesive story for this yet, but I am going to talk about this. Not today, eventually. So going back here, Las Vegas and my my investment mentor has mentioned this many, many, many times that Las Vegas is a canary in the coal mine. Las Vegas reached, and I'm telling you this because maybe my sister's listening because she's a real estate broker in Vegas. Vegas says that they're doing okay. Everybody says everything's cherry, everything's great, volume's up, everything's going well. But again, I tend to want to say that that's they're reporting on the lagging indicator, just like we were talking here with the orange cells, right? Las Vegas went over 5,000 listings, active listings. Again, it's the same target demographic house that I'm looking at. Less than $2 million, 3+ bedroom, blah, 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 right? Single family home, not a HOA, not a condo, not a PUD, not a multi, whatever. This is just what I'm looking at. So we can have everything kind of equal. That's kind of scary. Just a month ago, it was 1,200 less. Well, 1,150 less or so. That's crazy. Tampa, slowly growing. Cape Coral, slowly growing. This, I think, is one of my areas that I'm going to be focusing on, Cape Coral. Their numbers are out of whack. Cape Coral is it's a second house city. More people live there part-time because in Florida, you have a lot of, what do they call it? People that live in Minnesota and get out of the snow for a couple months and they move down to their place. So I think what's happening is there's just a huge glut of inventory right now. I also think it's a destination city. Anything that might be a destination city, meaning you would have investors buying homes in I don't know, let's say Chicago or Nashville, because it's a destination. People go there for vacation or go there to watch, the Grand Ole Opry or what have you. And they're going to, say, hey, you can get an Airbnb there. And Airbnb is a great idea. Problem is everybody's touting Airbnb. There's VRBO and all that other stuff, but it's short-term rentals is what it is. And I think that market's going to dry up or slow down or reach its peak, the natural equilibrium of anything. And I think what you're going to see is everybody's buying on the idea of short-term rentals. You can make a whole lot more money on short-term rentals. But if you oversupply the market with that and your natural equilibrium, say 1,000, and you have 2,500 units for rent on Airbnb or whatever, the natural equilibrium is going to bring prices down. So people are going to be forced to sell. That's just in my head. A lot of these places, I don't know if Jacksonville is a destination place. It's Florida. People like to go there for sure. I know an agent and she sells a lot of Airbnbs out there. Knoxville. The only reason why I check out Knoxville, it's a very small town. My parents live there. I'm going there in September, checking it out, flying into Nashville. I'm going to be spending some time checking out that area. I've been to all of these other areas as well. I haven't spent a lot of time in Atlanta, but I have been there. Spent a lot of time looking at all these different areas. And that's really where we're looking at, trying to figure out where the next crash is going to happen. So, and these numbers again down here are just equalizing numbers, right? If you look at these numbers, I'm trying to figure out how to give you, a viewer, an indicator as to what's equal, because no two cities have the same square mileage. No two cities have the same population. So what do? You divide it by the square miles and you divide it by the population by 1,000. And that's how I have it right here. So for example, currently, based on that same demographic, 3-bedroom houses, less than $2 million, single family home, there are actively 3.8 homes for sale per square mile in San Jose. Same thing here, 0.667 homes for sale available per 1,000 people in San Jose. So you kind of get a baseline number that you can compare it against other cities. Like Chicago has 11 houses per square mile, and 0.94 houses for sale per 1,000 people. Happy to share this with you. I would take a screenshot and send it to you. Just DM me your email, and I'm happy to share this with you. These updates are here every week. You can absolutely take them from me. I'm not here to hoard them or what have you. And that's where I get some of my news. Happy to share this information with you. So you can share it with your friends, your colleagues, your better halves, what have you. These numbers are straight from realtor.com. And the only reason why I'm offering this is so that you have some information. And yeah, I'll put you on a little list. But guys, I think what we're going to see is this number is going to go down. I think we're going to see numbers around 90, 95% in the coming months. And I think this days on market is going to go high. A normal market is 2 to 3 months consumption. A normal market is 2 to 3 months consumption. We have right now, where did I look at? 1.5 months of normal consumption, right? A buyer's market starts at 6 months. Once it becomes 6 months absorption rate, meaning it takes your house an average to sell an average of 6 months, then it's a buyer's market. Right now, we're seeing a downward trend, and people are kind of normalizing the actual value of homes, trying to figure out what people are willing to take and what people are willing to buy with. So this has been over the last year. Sorry, I gotta get this so you can see it there. Over the last year, maybe I should shrink this up so you all can see it. That would make way more sense, Vito. There. All right. Again, we're spreading this out 4 weeks, 5 weeks, because every month has 4 or 5 weeks. These are the aggregate, not an aggregate. These are the every month reporting of absorption. We're down to 0.3 in December. That's crazy, right? Days to sell over time. Again, we're seeing 2018, 20, 21 numbers right now. We had it down April, March, and February. We peaked in April. That's what I've been telling people. We peaked in April for 9 days average. That's average. We were selling houses in hours. Some houses would be like, here's $500,000, take it now. I'll take $500,000 as is. I'll close in 5 days, and you can stay in for 3 months free. That kind of stuff was happening all day long. Remember, I told you a couple months ago, the highest sales price to list price, not ratio, but actual price was like it was listed at 3.8 million, sold for $2.7,107,000. That's not happening anymore. So if you're thinking about buying, right now is a great time. If you're watching the market go down, you should absolutely buy. You buy dollar cost averaging, kind of like when you buy stock, buy multiple homes. Absolutely. And then if you're at the trough, buy as many houses as you know. But again, you don't know when the trough is. You don't know when the bottom of the market hits and when we're going to start turning around. So, as we see the values go down, you're going to see more people enter the market. In 10 years, if you buy today, in 10 years, your house is probably going to be worth a whole lot more than what you buy it for. So if you bought it at $1 million, if you look at the numbers, let me see if I can get that for you real quick. There it is. This is historic since 1960. Everybody says the value goes up about 8% every year on the aggregate. Well, I think if you compound it 8%, you're closer to 15%. We're seeing about a 15% average, except for the last couple of years, which again, I don't think this is natural. I think this is going to come down or normalize around here. So this graph will probably become a little bit higher, but I think we're at about 15%. So if you buy today at this price, or even like this price, because some houses are being discounted right now, in 10 years, your house is going to be worth 15% more, 18, 20% more. This is national, historical, right? Your areas are going to be different. You just don't know. All right. Yeah. There you go. All right. TikTok. I'm on TikTok now. I don't know if you want to watch me, but there you go. Video of the week is 5 cities near San Jose. If you're thinking about moving to San Jose, go to Silicon Valley, go to youtube.com/Silicon Valley Living, and you'll see this 5 cities near San Jose, or you can just copy this, or you can DM me and watch the video. Either way, you're going to get it. San Jose is a great town, has a lot to offer, has a lot of things to do. It's a big city, though. Not everybody wants to live in a big city. And after living here for, I don't know, 20, 30, way too long, if I were to move, I would move to a smaller town, simply because metropolitan areas just don't offer what I'm looking for these days. I want to have a slower lifestyle, etc., blah, blah, blah. So we have Morgan Hill, Gilroy, Sunnyvale, Los Gatos, all these different amazing areas that cost a little bit more. Morgan Hill, not so much, but that's further away from the epicenter of our market. So there you go. I've been talking for 41 minutes. We talked about home prices. Yep, we already talked about all that. Why I chose Compass. I just did my office meeting, the office meeting, where my office manager spoke, and Compass, wouldn't you know, out of the top 5 offices in the Valley, Compass has 2 spots. And for a relatively new company, that's pretty amazing. They did acquire talent. They offer some really whiz-bang marketing products for us and for our sellers. We have a top-notch app. It's not perfect, but it's great for us to work in. It's great for us to communicate with our clients in. If you're a client or you're on this, you happen to see this via the email, they went through the Compass app. You don't care. We also have a concierge program where we can offer up to $75,000 to help you do repairs, all sorts of different things, staging inspections. When you sell your house, it's expensive. When you're moving, it's super expensive because you have, movers. You have to buy another place. You have moving costs. You have to live out of hotels and fast food and restaurants. It's really expensive. And we understand that. So we offer a little bit of money to help offset that you pay us back. If you borrow $10,000 or $75,000, you pay us that back. There's no fees. There's no costs or interest rate. So there you go. Palo Alto, which is one of our offices, year to date, within 6 months, topped $1 billion in revenue. That's crazy. That just goes to show how much money is out there. It's just crazy when you're selling houses. Speaking of which, this TikTok this week, our top houses that sold, we're in San Francisco. They're condos. They were a penthouse A and B, and one side sold for $17 million, and the other side sold for $12 million. And the one side that sold for $17 million, the HOA is $7,800 and change a month. Crazy. So yeah, pretty interesting information there. Willow Glen is second office. Is the Willow Glen office, the one I have my office in. My team hangs out there. Is second in revenue overall. I think it's either second in revenue or second in. I think it's second in numbers. Now that I think about it, and the reason why we do that is we want to hang out with people that are successful. And if you're an investor, if you're an entrepreneur or a motivational kind of guy, everybody always tells you to hang out with the most successful people in the room. We don't have that problem in with working with Compass. Everybody there is open, honest. They're best of breed. Not to say anything disparaging against anybody else. I can tell you I worked for Coldwell Banker for a few months. The reason why I left is concierge, and their software was just not tenable. Coldwell Banker, I have nothing wrong to say about them. They train best in breed realtors. They're amazing professional clients or agents. But when you have a pool of massively successful agents, it helps us raise our service to you as a client. So yeah, and that was a little pitch, but that's just where we are. All right, that's it for today, guys. Thanks a lot. I really appreciate everybody hanging in there. Reminder again, we're having a little talk with Kelly tomorrow. I'm excited. She is just such a huge depth of knowledge of this market, and I just can't wait to get into her head and answer some questions. So if you have questions, shoot me questions and I'll be able to answer them for you. Thanks a lot for watching. I'm Vito Scarnecchio with the Albatano Group, powered by Compass. We'll see you out there. Okay.